The U.S. economy grew in the third quarter at its fastest rate in 2 years, driven by strong consumer and business spending. My next guest says growth benefited from the AI CapEx cycle, though the primary factor was the resilient U.S. consumer. Let's go to Oscar Munoz. He is Chief U.S. Macro Strategist, TD Securities. Thanks for joining us today.
Thank you for the invitation.
So a weak consumer sentiment, we know that, even today's numbers show that, but softer labor market as well. What's driving the growth?
Yeah, that's the million-dollar question for economies here. But you go back to the GDP print for Q3 at 4.3% quarter on quarter from July to September. That's the same period where we saw job gains really markedly slow down. That tells you a little bit about productivity growth. We're tracking 5% productivity growth for Q3. It was already very strong in Q2 as well, where the economy also expanded at a very solid pace. So I guess you have to buy the story that productivity is here to stay. And it's actually probably something that the Fed is already assuming in their projections for 2026.
Okay, so how much, what does that indicate? How much of it is or could be AI capital expenditure?
Look, I think if you look at just the investment side of the report, AI continued to contribute a good chunk of it. If you read it from that perspective, 0.5 percentage points of growth that we saw today for Q3 was from AI investment. But if you actually do the math, most of that is imported. So the real impact on GDP growth is not as large. But again, it is a big driver of investment. It will probably continue to be a key story for growth in 2026, but we don't think it's going to be as strong as it was in 2025.
The suggestion is that things will slow down in the fourth quarter for the U.S. How much of that will be because of the government shutdown?
Look, a good chunk of it, we're assuming 0.7 percentage points is from the shutdown. That will come back in Q1. So you're going to see the shock in Q4, but you're going to see the payback in Q1. Actually, as you mentioned before, the main story for that upside surprise in economic activity for Q3 was the consumer, particularly the spending on services. We know now in Q4, given the data that we track, high-frequency credit card data, we know that the consumer is stepping back in terms of spending. So I think it's going to be a two shock to the economy in Q4, government shutdown, and consumers actually slowing down their pace of spending in Q4.
Okay, so consumer spending has been still strong, as you were talking about what could be to come for the end of the year. But consumer spending has been pretty strong so far. And I'm wondering whether or not tariffs have worked through the way you thought they would, or perhaps they're being absorbed by retailers. And that's why we're seeing, at least until now, consumers still spending.
Yeah, I think it's a little bit of both. I think so far, retailers, U.S. companies have been absorbing the shock. Some of that has been passed on to the consumer. We see it in goods inflation, right? You see some of the items that are highly exposed to trade with China, for instance, toys. You've seen the price increases there. So on the good side, you've seen pass-through. Certainly not as strong as most of us expected earlier in the year. But, to go back to the consumer is not an aggregate consumer story. I think it's very bifurcated. I think you've probably heard about the K-shaped economy. Most of the spending is being done by the upper income consumers. They continue to spend out, particularly on services. And if they continue to do so, the consumer is going to look good in the aggregate. So I think that's what we're seeing at the moment.
Okay, so we talked about the fact that the last quarter of the year could be a little bit weaker. It could be weaker for the consumer as well. But next year, we have to factor in, of course, tax refunds, the one big beautiful bill working its way through. How do you offset them?
Yeah, look, I think we're very positive on economic activity for 2026. I think Q1 could be a very strong quarter as well after slowing down, which is what we assume in Q4. You're going to see the tax refunds, as you mentioned, that should lift or maintain consumers spending strong. You're going to see the payback from the shutdown. And to be honest, Q1 data tends to be strong. January, February data is usually firm. It tends to surprise to the upside. There is some seasonality there, but you go back to prior years, January, February inflation payrolls, they tend to beat expectations. So I think Q1 right now is set up to be a very strong quarter. And then the rest of the year, we're looking for the economy to expand close to its potential, around 2% growth. So I think the economy will just do fine. The main question remains the labor market. The labor market continues to lose momentum. You've seen the unemployment rate continuing to move higher. So the big question mark for the U.S. economy is what happens to labor market conditions at the start of the year, whether the unemployment rate stabilizes at the current levels at 4.6%, but if that continues to move higher, I think that will really have an impact on what happens with the U.S. economy in 2026.
Can you give me your outlook for inflation for 2026?
Definitely. So we do expect pass-through to remain part of the story in Q4 and in Q1 as well. We're seeing inflation probably rising to 3 or 3.1% between now and the first half of next year. But after that, I think the tariff story goes away, it phases out, and we think that services disinflation is what's going to be the main driver of the story in the second half of the year, particularly explained by disinflation in the housing segment, OER rents. We expect that to continue losing momentum and dragging down overall inflation toward 2.5% by the end of 2026.
Okay, and then where do you expect the Fed Reserve to land? You mentioned job losses and that weakness continuing. What do you expect for cuts next year?
So we do have additional 3 cuts from the Fed penciled in, now more gradual than what we saw since September this year, 1 per quarter, 1 in March, 1 in June, 1 in September, 25 basis points each. Now, there is a big question mark about what happens in March. We think January is a done deal. I think the Fed is going to pause. March is a big question mark because of what I just mentioned. I think that the economy will probably show resiliency. It'll probably the activity will remain strong. So it'll go back to the labor market, as I was mentioning. If the labor market continues to stabilize at 4.5%, 4.6% in terms of the unemployment rate, I think the Fed can stay on hold for a little longer here.